Have you been following the big news from Wall Street recently? A former OpenAI researcher named Leopold Aschenbrenner has his hedge fund right in the middle of a huge market storm. How crazy was it? In the first 6 months of this year, by focusing on the AI supply chain, his fund made a 439% return. That's almost 4.4 times the money. At one point, the fund managed more than $20 billion. But in just 1 month, everything changed. When AI-related stocks fell hard, his fund got into serious trouble. Because he used a lot of borrowed money leverage, he faced big margin calls. He had to sell a huge part of his public stocks, about $16 billion worth, to Griffin's Citadel in a rush. The fund's size dropped by more than half, almost overnight. It lost about 67% in July alone. Even after this roller coaster, his total return for the year, through July, was still around plus 80%. That's still better than most people and most funds. So, what can we learn from his story? Let's take a closer look. Lesson 1. Spotting the right trend early can make you a lot of money. First, we have to give him credit. This young investor is very smart. When you really see a big trend early, the market can reward you a lot. He started college at 15 and graduated as the top student at Columbia University when he was only 19. He studied economics, math, and statistics. After that, he worked at the FTX Future Fund and later joined OpenAI as a researcher. After leaving OpenAI, he wrote a famous 165-page report called Situational Awareness. It predicted big changes in AI and became very popular in tech and finance. His way of finding good stocks is simple but powerful. Look for scarcity. He studied how artificial intelligence would need more chips, more data centers, more electricity, and more storage in the next 10 years. He put money into the companies that would benefit from that shortage. Many normal investors wait until a stock is already famous and expensive before buying. But real investing is about looking into the future. Because this young man understood the big trend early and focused on the most important shortages, he made 439% in just 6 months. It shows that if you see the trend clearly and early enough, the market can make you rich. Lesson 2. Putting almost everything on the same idea is dangerous. Options don't always protect you. Making money is one thing, keeping the money is another. The second lesson comes from looking at his fund's public filings, 13F reports. His strategy was very aggressive. About 60% of the reported positions were put options. He used these puts to bet against big AI chip companies like NVIDIA, TSMC, ASML, and others. At the same time, he put a lot of money into more volatile stocks in power, storage, and data center infrastructure names like SanDisk, CoreWeave, Bloom Energy, and IREN. On the surface, it looked like he had both long and short positions, like a smart hedge. But if you look closer, almost everything was still betting on the same big idea, the AI boom. There was very little real protection. On top of that, he used high leverage. Some reports say up to 4 times. That means every move in the market was magnified. When the market went up, the fund went up very fast. But when AI stocks fell even 10, 20%, the losses became huge very quickly because of the borrowed money. Margin calls forced him to sell at the worst possible time. It's like putting all your chips on the same hand in poker. When the market turned against him, he had no choice but to sell everything in a hurry. Lesson 3. Fund managers often play with other people's money. The third lesson is the deepest one. Never forget how cruel and unpredictable the market can be. And never blindly trust professional funds just because they sound smart. Every big technology boom, the internet in the 1990s, crypto, and now AI, creates new young geniuses. They are usually very intelligent, confident, and full of energy. For a while, the market rewards their boldness and puts them on a pedestal. But we need to look behind the success stories. In the hedge fund world, managers often take big risks with other people's money. If the bets win, the manager gets big performance fees, and becomes famous. If the bets lose, the clients lose most of the money. As long as the fund grows big and gets attention, the manager can still do well. Most regular people would never take such high-risk, highly leveraged bets with their own savings. Young talent has energy and a good feel for new technology, but they often lack the painful experience of real market crashes, panic, and dry liquidity. No computer model can fully prepare you for panic. The market is not just math, it is also human emotion. To sum up, Leopold Aschenbrenner's story is fascinating. His ability to see the AI trend and focus on scarcity helped him make a fortune in a short time. But the hard truth is this: being right is not enough. Making money is not the same as keeping the money. For all of us trying to build wealth, this story is a good mirror. When someone makes huge returns very quickly, it is often because of heavy leverage and other people's capital, not just pure skill. In investing, the most important rule is not how fast you can get rich. It is making sure you do not get wiped out. Protect your principal. Do not copy someone else's reckless, high-risk bets. That is how you stay in the game long enough to win. What do you think about this story? If you found this video useful, please like, subscribe, and share it with friends who are interested in investing. See you in the next one. Bye.